Welcome to Know More, Risk Better, a CreditSights podcast. Across the global strategy team, we aim to make sense of the macro and the micro, highlighting opportunities and the risks facing the fixed income markets.
As the macro makes headlines, we leverage our network of experts across Fitch Solutions to better understand economic trends, rates gyrations, geopolitical events, and how these factors impact corporates.
At CreditSights, we understand that credit investing comes down to picking winners to generate alpha and avoiding losers. Our team of over 100 analysts across the US, Europe, and Asia provide unmatched sector expertise and fundamental knowledge.
In our weekly podcast, the strategy team offers a look at the conversations we have with our colleagues, including analysts, fellow strategists, economists, and leveraged finance market experts. If you want to know more so that you can risk better, you'll want to give this podcast a listen. Hello, everyone. Welcome back to the CreditSights Know More, Risk Better podcast. This is Winnie Cisar, Global Head of Strategy at CreditSights. And today we're doing something I would say that's a little bit different. We do have one of our favorite experts, Pat Luby, our senior municipal strategist. And as we were joking before this podcast recording started, our ETF emperor, truly an expert in all things exchange traded funds. And that is what we are going to be talking about today. Our goal is to provide you a little bit of an ETF 101. I think a lot of people know that ETFs have become very popular over the past 10 years or so. But some of the mechanics of them and really the opportunities within them are maybe a little bit less understood. Pat, you have been deep in the world of fixed income ETFs for the past 10 plus years. Can you first just tell us why? What exactly makes them so interesting to you?
You bet. And, I come at ETFs as a bond guy. I've been in the municipal bond business my entire career, and as ETFs were gaining traction and prominence in the market, my observation was most of the people in the ETF business came from the equity side of the world, and so they frequently positioned the products from an equity mindset, and they didn't necessarily always understand how to explain ETFs and how they fit into the daily workflow and the objectives for a professional fixed income practitioner. So a lot of the fixed income practitioners just kind of ignored them because there wasn't a good way to explain them. So 10 plus years, I set out on a mission to understand them, and even was on the ETF talk circuit. I've spoke at a number of ETF events explaining the fixed income proposition, the benefit to fixed income participants of thinking about the ETF wrapper. And so where did this really start? Well, for the entire length of my career, everyone's been paying attention to fund flows. What are fund flows doing this week? So it's a good, highly correlated indicator of investor demand. And for most of my career, that meant mutual funds. But then, of course, as ETFs started growing in prominence, the ETF flows kind of got lumped in with the mutual fund flows. Early on, that was not that big a deal because the ETFs didn't have that much heft to them. But the fund flows are super helpful because it provides a mirror into demand. If flows are in, investors are buying, they're putting money into the funds. And of course, if the flows are negative, the reverse is also going on. But as ETFs have grown, they have attracted more investor types than the mutual funds typically have. 94% of all mutual funds are owned by individual investors. So watching the fund flows in mutual funds, it provides great insight about changes in demand from individual investors, but it doesn't provide as much insight into what institutional investors. But the ETF ownership is much more broadly diversified by investor type. So for example, LQD, which is one of the largest IG corporate bond ETFs, 46% are owned by investment advisors, 19% are owned by insurance companies, 13% by banks, which could be wealth clients through their broker-dealer subsidiaries. And so you've got a little bit of a difference there. HYG, the largest one of the largest high yield corporate ETFs, 54% advisors, 13% banks, 10% pension funds, 6% insurance companies. MUB, the Muni ETF, 69% advisors, 19% banks, 5% brokerage, and 3% trust companies. So because there's different types of investors, we feel very strongly that it's super important to look at the mutual fund flows separately than the ETF flows. And so, yes, we report both, but we break them out separately. One of the other things that makes the ETFs so much more helpful as an indicator of demand is it's not just the flows in and out of the funds, which is what is happening in the primary market where the shares are created or redeemed. And so the share creation flow, the redemption flow is what drives the change in assets under management. So when we or anybody else is reporting a change in net new asset flows in the ETFs, that's really a function of the change in the shares outstanding. But those shares trade in the secondary market. So there can be an enormous amount of activity of trading in the shares in the secondary market without necessarily leading to the creation of new shares. So if you're watching only the net new the flow of assets into or out of either an individual ETF or a whole class of ETFs, oh, it's quiet, there's been no flows. But secondary market trading could be enormous. So we always pay attention to the turnover, which is the market value traded in the ETF, as well as the creation, the net new asset flows. Now, depending upon what's going on with the price action and also the turnover, it could be a leading indicator of shares may be close to getting redeemed and taken out of the float in the market, or shares may be getting ready to be created in the market. So the two indicators that we encourage our readers to take a look at is both the turnover, and we show, for example, in the weekly, we show the average daily turnover for that week. It's abbreviated ADT. We compare the weekly, average daily turnover versus the prior 4 weeks and the year to date. So if you see that turnover is elevated, then also look at the closing price of the shares relative to the NAV. If the shares are trading above the NAV, that means potentially that an authorized participant could deliver some bonds, get some shares created, and theoretically sells the shares at a premium above what the cost of the bonds are. That's a slam dunk, right? The AP is going to want to do that. If they can sell the shares at a premium, they're going to want to create some shares. So seeing that the ETF closed at a premium is a good indicator that there's more demand for shares than there's shares available. The reverse is also true, of course. If the shares are closing at a discount to the NAV, that tells you that the evaluated pricing of those bonds is not keeping up with where the ETF shares are trading. I think the large, highly liquid ETFs are a much better indicator of price discovery and investor demand than where the pricing services are marking bonds at the close. So when you see those ETFs closing at a discount to NAV, that's both telling you that the price evaluations that drive the NAV are too high, and that there's sell demand. Investors are exiting the market. They're willing to sell below the evaluated price, below the NAV. That also means that shares are probably going to get redeemed as well.
Yeah, I think that those are really great points, especially your last one around kind of the delta between where perhaps indexes may be marking versus ETF NAVs, because ETFs are plausibly kind of covering the most liquid parts of whatever their underlying market is. And so when I think about the US investment grade market, you have this cohort that gets traded quite frequently, the on the run bonds, the recently issued, et cetera. And then there's an awfully long tail of bonds that just don't trade, but
Mhm.
tend to get repriced by the pricing services. And I think that ETFs filter out some of that noise, which is really important. So you covered some of the really great kind of headlines around ETFs. And I'd like to get into some of the nitty gritty because, as you mentioned, fixed income people don't necessarily understand kind of the mechanics of ETFs, some of the importance. And let's just start with, why are they so popular? We've seen a tremendous rise in ETFs over the past 10 years. Why is that?
Well, there's really three main drivers of the growth and popularity: cost, liquidity, and tax efficiency. Cost is self-evident. LQD has an all-in management fee of 14 basis points. HYG is 49 basis points. MUB is 5 basis points. If you look at HYD, which is one of the oldest one of the largest high-yield muni ETFs, it's 32 basis points. NH Max, which is the largest open-end muni high-yield mutual fund, has a 48 basis point management fee, plus there's a 20 basis point 12B1 fee. There are not 12B1 fees associated with the ETFs. So just right out of the gate, the cost that an investor is paying through the reduced income of the management fees is much lower with the ETFs. That means that the ETFs can trade closer to the NAV also because the costs are more effective. The growing liquidity of the ETFs and the fact that they are exchange traded and not traded over the counter, like our favorite bonds are all traded over the counter, which has pluses and minuses to it. But one of the things I've said, particularly about munis, because of the high average credit quality in munis, one of the greatest um, risks to investor principal in the muni market comes not from credit risk, but from liquidity risk. How can you diversify? Well, you can diversify credit risk. How can you diversify liquidity risk? There's not a lot of things you can do. But if you have a portfolio of bonds that's relying on OTC liquidity, having a sleeve of exchange traded funds that replicate what it is that your policy is trying to pursue, but provides access to the exchange traded liquidity, you've diversified your source of liquidity. So that near instantaneous ability to get long or to get flat, even to borrow and get short if you want to, in the ETFs is really strong. Even when the markets are volatile, you may not like the price, but you can generally get out really quickly. And the quotes, the bid ask quotes on the large, well traded ETFs is generally very tight. And in fast market conditions, volatile market conditions, or large block size trades, obviously you'd want to have a voice handle on getting those trades executed, but they can frequently get done in between the bid and the ask. So super liquidity. And the tax efficiency. If a mutual fund needs to sell a bond that's appreciated in value, they have redemptions, they need to sell a bond that's appreciated in value. Obviously, that creates a taxable capital gain that will ultimately be distributed to the shareholders. In muni land, muni shareholders hate that. They want tax exempt income. They hate taxable gain distributions. In an ETF, because the bonds aren't sold to fund redemptions, because the fund isn't taking the redemptions. The redemptions happen in the shares at the exchange. So investors getting out of the shares are selling their shares. Now, if the shares stack up at the AP and they want to redeem shares, they exchange those shares with the fund manager for securities. So the fund manager will deliver bonds out, and they'll receive shares in, they'll cancel the shares, but because it's not an outright sale, that's an exchange, it doesn't create a tax event in the ETF portfolio. And the ETF portfolio manager has the flexibility to decide which tax lot of bonds to deliver out. So if they've got a huge position in a very actively traded CUSIP and one tax lot is appreciated, they can deliver that tax lot out so it gets that capital gain out of the portfolio. So super tax efficient. They are structured as open-end funds. It's possible that they could have and distribute a capital gain, but they're managed to avoid those capital gains. And because of that exchange mechanism, it generally gets those capital gains out of the portfolio. So generating a taxable capital gain in the ETF is not very common.
Yeah, that's a super helpful overview, and I think that the tax efficiency component is probably the least kind of appreciated and understood, at least from the people I talk to around ETFs. All right, Pat, so you've mentioned a few times the AP, the authorized participant. What do they do? And I think also who are these authorized participants? Can I be one? Sounds like a good gig.
If you've got the balance sheet, so the large broker dealers typically will have a trading desk that functions as an AP, an authorized participant. The authorized participants enter into a contractual relationship with the ETF sponsor, and they're the only ones who actually transact with the ETF sponsor in creating or redeeming shares. So they have a multiple roles that they play, because not only will they transact with the ETF sponsor when shares need to be created or redeemed, but they're generally also going to make a market on in the equity shares themselves. So they're sitting there and they're making a market in the equity shares. They're seeing how trades are moving in the equity market. They're also paying attention to the NAV and the intraday NAV of the bonds that are in their baskets. So they've got really good visibility into the flows of the shares and demand, whether it's buying or selling. And again, this is an equity market, so they can see, are trades getting done at the bid side or are they getting done at the offered side? That's really helpful info, which I forgot to mention that we include in the ETF reports. We'll show you the percentage of turnover that's executed on the bid and the offered side. But so the authorized participant is watching the flows in the equity shares. They're watching the pricing for the underlying bonds. And when there's an opportunity to create or redeem shares, then they're the ones who will transact with the fund sponsor. So the large broker dealers are typically will have within them, they'll have a desk, a department that serves as the authorized participant. There's also some of the large trading firms. I don't know that we want to mention them here, but everybody knows who they are. The really big trading shops, they've got large AP operations. Now, one of the things that's really interesting, especially in munis, where it's super hard to hedge munis because they're tax exempt. You can't short munis. If you borrow MUB, you have to gross up the interest on those because somebody's giving up their tax exempt coupon. Running a trading desk as an AP is one of the few ways to efficiently intraday hedge your trading risk. So if you can tell early in the morning that you're going to be accumulating shares, well, if you've got an opportunity to sell some shares, maybe you're going to sell those short, just do a naked short intraday, knowing that at the end of the day you're going to be flat shares for the day. So they've got good opportunities to engage in hedging. If it's a broker dealer who is actively making a market and taking positions in the underlying bonds themselves, being involved in the trading of the shares, which are going to be correlated with those bonds, is also a more efficient way for potentially for them to hedge their risk.
Absolutely. I think that the hedging question has been kind of a thorn in the side for so many credit market participants for so long. And we'll probably get into a little bit more of that later. But before that, now that we know AP, what are some of the other ETF related terms? I feel like we should put together an ETF glossary for people in the bond market, just like our cover review people did
hmm
for the leverage finance markets.
Yeah, I think a primer is actually overdue for ETF, so we'll definitely do that. But um, certainly for bond market professionals, two of the key terms that hardly ever get spoken of by ETF professionals is there is a primary market and there is a secondary market. We touched on that already, but just like our bond markets, where bonds get created and underwritten in the new issue market, there is a new issue market for the ETF shares, and it's a continuous market. So once the ETF is created, the shares can be tacked on. It's like a shelf registration. Shares can be tacked on and expanded or contracted depending upon on demand. That all happens in the primary market, and as I mentioned before, gets reported as changes in the net new assets. And of course, those shares, once they're issued, trade in the secondary market. And there will be an enormous float depending upon the size of the ETF and also the scale of trading demand, there will be a float in the secondary market. And the APs are watching that, so they're going to figure out, well, how much float is there left in the street? And if there's not enough float or there's too much, then they will accumulate shares or they'll accumulate bonds, and they'll go to the issuer and they'll ask for new shares to be created in the primary market or canceled some shares in the primary market.
All right. How many ETFs are there? Because, I think it's important to set the stage a little bit into just how much liquidity these vehicles ultimately provide, and then also, relative to the size of the corporate and muni bond markets, how big is the ETF share? Like, what does it represent overall?
It's big. So as of last night's close, there were over 2,000 U.S. equity ETFs that we had in our weekly report, $8.4 trillion in assets under management. U.S. fixed income ETFs, 810 fixed income ETFs with just over 2 trillion in assets under management, 145 Treasury ETFs. In your neighborhood, IG corporates, 115 ETFs with 310 billion in assets under management. Compare that to IG mutual funds, however. Mutual funds, despite all the attention paid to ETFs, mutual funds are not going away. IG mutual funds, 496 IG corporate bond mutual funds, over $2 trillion of assets under management. High yield corporate mutual fund, high yield corporate ETF, 77 with 101 billion in assets, 213 mutual funds with 336 billion in assets. In munis, there's 164 ETFs with 203 billion, 473 mutual funds with 876 billion in assets under management.
That's a great recap. And one thing that I think is maybe interesting or maybe less appreciated around the ETF universe is they can be incredibly stylized, even in the corporate bond markets. I vaguely remember looking one time that there's a triple C high yield energy ETF, which is very specific. So I think a lot of times as people are thinking about ETFs versus mutual funds, it's the old passive versus active debate. And that may not necessarily be, 100% true. What do you think?
Absolutely, and that's why there's 473 muni mutual funds. Why there's 160 ETFs. They're not all trying to do the same thing, but from an investor's perspective, all of these ETFs have a potentially different role to play depending upon what they're trying to get done. But they're super efficient. They're broadly diversified. Some are active, some are passive and index tracking. So it really comes down to what is the investor trying to get done, and there may be an ETF out there. Some of the things, I mean, we've written about this that I think are really interesting is iShares has a number of ETFs that does covered call writing in the ETF. So in a sideways market condition, the option premium that the ETFs are collecting adds incremental income to those ETFs. So like LQD has a buy right version of it. LQDW, TLT has a TLTW. Those are really interesting. Maybe not necessarily right now, but we've been in market environments where things are going sideways and it's kind of dull. Well, here's a way to add some option income. So yeah, there's a number of different objectives that the
Mhm,
the managers are trying to carve a niche for themselves
mhm.
as well. And so depending upon what the buyer is trying to get done, they need to make sure that they're looking just beyond the biggest names.
Yeah, beyond that, I think that we alluded to ETFs being a, more effective, better credit market hedge for munis. I think the same is true for high yield and investment grade. We all have seen kind of the decline of the single name CDS market, and CDS indices oftentimes don't quite cover what is happening within the broader cash markets. ETFs, as you were mentioning, so many flavors, and we also have the ETF options markets.
Hmm.
So there's a wide array of ways that people can kind of use those as credit market hedging. How else do you see bond market professionals using ETFs?
Well, there's SMA managers who build entire multi-asset portfolios only with ETFs. So whereas they may have been doing individual securities in the past, now they're using ETFs only. Um, and they may in each fixed income product class use just a couple of different ETFs, and even within the ETF. So for example, in IG corporate, high yield corporate, and in munis, there's multiple providers who have bullet maturity ETFs. So you could even build a laddered portfolio with IG corporate bond ETFs. Um, might you want to do that in addition to a bond portfolio? Absolutely. Um, assembling a portfolio of bonds that maybe has some museum pieces in it that might be difficult to replace if you need to adjust for the market. ETFs allow you to tilt the characteristics of your bond portfolio. So, doing a tactical overlay on temporary market conditions, which is hopefully where we are right now, right? Is the Iran-induced market volatility. Hopefully, it's not going to go on forever. But if you want to do something in a portfolio without disturbing the bonds, you could use the ETFs to do that. Add or subtract duration, add or subtract credit risk. All sorts of things that you could do that way. For even large investors like an insurance company, for example, or even an institutional SMA manager, I've long been a big proponent of including the largest, most liquid, most actively traded ETF for your space in the fund as a liquidity sleeve. So if you need to raise funds when the market is in challenging circumstances, the exchange traded liquidity provides a near instantaneous way to liquidate. Um, I'm also a fan of using ETFs in individual SMA portfolios, any portfolio that may want to do tax loss swaps, because the ETFs can be a really good tool to have in a portfolio. If you're selling a position to harvest a loss or to take a gain, and you have an existing exposure to an ETF, then potentially if you're doing a replacement, you could use the ETFs and you can use the seasoned position so that you don't have a short-term gain on the piece that's coming in on the buy side. So there's a lot of different ways to do it. At the very least, bond market professionals should be watching the key ETFs for their part of the world. It should be on their screens and watch what the flows are doing, how the trading is going, and what the prices are doing.
Absolutely. I think another thing that people should be watching is which bonds are actually owned in those large ETFs, because there will be issuers that, let's say have a cap stack of 10 different bonds across the curve and only 8 of them are ETF eligible. And so understanding what is owned by which ETF is, I think, really important to just kind of understand what is happening within your own portfolio, because sometimes in these periods of volatility, you're going to see outsized downside and upside performance in some of those cash bonds that are more aligned to
Mhm.
ETFs, whereas some of the other ones are not going to be trading nearly as frequently. And there's always trying to eke out that extra
Mhm.
little bit of performance.
Yeah, yeah. No, I think that's a really great point and not widely understood. There is actually academic support for that statement. There's been academic studies that have looked at the trading characteristics of bonds that are in portfolios. The studies looked first at investment grade corporates, but also did it for munis. And unsurprisingly, it found that for bonds that are in an ETF, those bonds have greater liquidity than the bond. Even when a bond that was formerly in an ETF, if it moves out of the ETF and is no longer present in the portfolios, it loses the liquidity. And the explanation for that is our friends, the APs, the authorized participants, who are often more of an equity trading shop than a bond trading shop. They don't necessarily care about the bonds. They care about the trading flow of the shares, but the trading flow of the shares depends upon how those bonds are trading. So for every bond in the portfolio, they've got a very sharp pencil. If it leaves the portfolio, they don't care. It's off their pad. So that explains why there's superior liquidity in those bonds that are included in the ETFs.
Yeah, so important, and especially important within the corporate bond markets when we have upgrades and downgrades, right?
Hmm.
Because some of the high yield ETFs are very duration constrained, whereas the investment grade ETFs have a much longer duration allowance. And so if you have, a big company, Occidental Petroleum, Ford getting downgraded to high yield, a bunch of those bonds are going to fall out of the main ETFs, and that kind of changes the dynamic pretty significantly. And then on the way back up, back into the ETFs. So paying
Hmm.
attention to that, I think, is really important overall. So Pat, you have walked us through so much as it relates to the mechanics of ETFs, why they're important. If people want to know more, if people are looking for help on the ETF topic, what are some of the helpful resources for clients?
Well, we publish really two really important views of the markets. One is on Thursday mornings. We publish the U.S. chart of the day, which has fund flows as of the close of Wednesday, which is why are we looking at fund flows as of Wednesday? Well, that's the way the mutual fund industry has always done it. So we report ETF and mutual fund flows as of the close of Wednesday. We don't have data yet for the latest week on mutual funds, but we tell you what the ETFs have done as of Wednesday and the revised and the updated mutual funds as of the prior Wednesday. So that's out every Thursday morning. Also in the US Weekly, at the end of the US Weekly, we have a deep dive taking a look at um, the calendar week flows in the ETF market. One of my favorite tables in there is the benchmark ETF. So it's got the largest and most liquid Treasury, Ag, IG, high yield, muni, bank loan, even crypto ETFs are in that table. So it's a great way to pay attention to what's going on in the market. We touch on all the data we talked about, the creations, the average daily trading volume, where it closed on that Friday, versus the NAV, and how much was done on the bid and how much at the offer. So Thursday chart of the day, the Monday morning U.S. Weekly, which is published before everybody's out of bed on Monday. And for those who are active in Muni land, the weekly Muni Catch-up, which also comes out early on Monday, has a deep dive on everything Muni. For those who are on Bloomberg, ETF Go is a great resource to help you poke around, see what's going on in the market. And of course, there's us. They can reach out with an Ask an Analyst that'll come straight to me or whoever else is involved in the ETF reports we're working on. And I'm always available on Bloomberg IB Chat as well.
Always available on Bloomberg IB Chat, except for when
Oh,
we're recording podcasts. Then we
yes,
then we
exactly.
close out of those. All right, Pat, this has been a really great conversation. I also love to nerd out on the ETF topic, so I guess we'll just have to get cracking on that ETF primer that you said we are long overdue to write.
Yeah, we'll do it.
All right. As Pat mentioned, if you have follow-up questions, you can always reach out to us directly using the Ask an Analyst function on the CreditSights website. You can reach out to your Fitch Solutions sales representative. And thank you so much, Pat, for joining me today to talk about ETFs. Thanks, everyone else, for listening.
Thanks, Winnie. Thanks, everyone, for joining us.
CreditSights disclaimer. All price references correspond to the date of this recording. This podcast should not be copied, distributed, or reproduced in whole or in part. Neither CreditSights nor its affiliates makes any representation or warranty as to the accuracy or completeness of any information contained in this podcast. CreditSights is not providing investment, legal, accounting, or tax advice, is not providing research or making any recommendations, nor is CreditSights offering or soliciting any transaction with respect to the purchase or sale of any security. The receipt by this listener of this podcast is not the giving of advice by CreditSights or its affiliates.